This is the 40U Tech Startups podcast. The podcast in which you hear all about the startups and spin-offs from the 4 technical universities in the Netherlands. From the challenges they face to the ecosystems they accelerate in, here we talk about what it takes to flourish and make impact on an international playing field. Brought to you by the 40U.
Welcome at this episode of the Dutch 40U Tech Startup podcast. Currently, we're at the Valo Hotel in Helsinki, home base of the Dutch delegation of this year's edition of Slush. Energy is high and stakes perhaps even higher as the Dutch team prepares for what is called the most founder-focused event on Earth. My name is Jochen Meischke, standing in for Vera today for this edition of the 40U podcast. And my guests today are Albert-Jan de Croes, venture manager at the University of Twente, and Joost Mathot, investment principal at Delft Enterprises. Albert-Jan, Joost, today we'll talk a bit about the unique challenges and strategies early stage startups and spin-offs face when it comes to investment and how to help early stage founders navigate the complexities of creating a solid and strategic approach to investment. Before we head to the questions, Albert-Jan, Joost, could you two introduce yourself and tell a little bit about your function as respectively venture manager and investment principal? So, Albert-Jan.
Yeah, great. Happy to be here. And of course, happy to tell a little bit more about myself. Albert-Jan de Croes, venture manager indeed at the University of Twente Holding. I think our functions are relatively similar. However, we do have a little bit of a different name to it. I have a financial background, alumnus of the University of Twente. Worked at Golden Egg Check and at a corporate finance boutique in Baker Tilly, so accountancy firm. And since 3 years now, I'm helping startup and spin-off companies raise funding, both from a role at Novelty and the University of Twente Holding.
Thanks. To Joost.
Yeah, so Joost Mathot, investment principal at Delft Enterprises. That's the participation company of the TU Delft. Which means we hold shares in spin-offs that are coming out of TU Delft. Currently, we have 73 companies in our portfolio. And my role within Delft Enterprises is being investment manager for a number of those companies. And next to that, portfolio-wide, try to help our companies with raising the next funding round and establishing and keeping contacts with the investors and looking at the deals that are made, that they are good for the startups and for us.
All right. Well, thanks for being here, both of you. So, as said, in this podcast, we'll talk a little bit about the challenges that startups face when it comes to funding. So, first off, why, according to you two, why is it so crucial for early stage startups to have an investment strategy instead of simply raising funds as need arises?
Yeah, I think in general it would be good if companies could be able to bootstrap, right? But unfortunately, science-based ventures, companies that spin out of the university, don't have that luxury usually. So there's a lot of capital and money needed in order to actually get their technology to market and into a product. In order to actually gain some cash from different customers. So knowing that you'll have to bridge a gap in a certain way, and usually you're not able to bridge that gap in one specific funding round, you'll require a specific funding strategy, and that involves different types of funding, subsidies, debt, equity maybe, over also different rounds, and that may differ what you need depending on the stage that you're active in, of course.
Yeah, I think also the type of funding you attract, it impacts the later stages, right? So if you get a convertible loan with a party, they will become part of your cap table, and it has to match with investors later on. So it's good to think, what will we need the next 6 or 7 years, and then work backwards how you can get there, and that's not biting each other.
Mm-hmm. And maybe one thing to add, I think investment strategies usually go back to, let's say, the venture capital backed cases, right? So the spin-off companies that raise venture capital. However, not necessarily for every company there is a venture case to be made. And well, maybe we can dive into that a little bit later. But the venture capitalists, of course, also need to make a return. And if you already know that you need to raise, let's say, 6-7 million in a market that's relatively limited, well, you might already know upfront that maybe you're not that venture backable case. And that might require you to change your entire fundraising strategy, opposed to then raising a first round of capital and then coming to that conclusion, which gives all kinds of problems.
Would you say that is one of the biggest risks for a startup? Like if they take a reactive approach to engaging investors?
Well, I think there are a lot of different risks. So I'm not sure if this is the biggest. I think there are larger ones. I do think it's a relatively big one, and one that's usually overseen at least by people that don't have experience. So the typical researcher that then becomes a founder of a company and is unaware of what is out there and what are the rules of the game, basically.
Yeah, and I think, although it's good to have a strategy, you should always have a strategy, but you should be adaptable as well. You have to be opportunistic sometimes. So you cannot think of your strategy at the beginning and hold on to that, because the world changes around you. The opportunities change. So you have to be opportunistic as well, but think about the consequences every step of the way, I think.
Yeah, and I think that's an excellent point that you make there, Joost. And I think I've also helped a lot of companies raise capital, and then usually you're starting with them, and you'll have this introduction meeting, and then you'll also try to manage expectations a little bit, right? So you think like, this might be an interesting company, might be an interesting founder with a product, but not necessarily right now would be the greatest time to raise funding. So you'll try to get that entrepreneur also a little bit into the mindset of what would you need. But at the same time, you have to be opportunistic, right? So if such an entrepreneur comes along and joins such a trip as Slush, I actually had such an entrepreneur where we made a long list together of different investors, and already the day after we made that long list, he had a meeting with a specific angel financier, and he was able to close the deal already the week after. So it was like there goes the long list. So you always have to be opportunistic and realistic at the same time, which is sometimes a difficult thing to combine with each other.
You're talking about first deals, closing first deals. Of course, you guys speak to a lot of startups. You see and advise a lot of startups. What common mistakes do you most see happening when they close their first deal, and how can they avoid them?
Well, I think in closing their first deal is not necessarily the mistakes. It usually comes before that. So we already talked about the funding strategy. I think if you're still planning your round and seeing what kind of capital you're raising, one of the predominant things is, let's say, trying to raise too big of a round. So without seeing, let's say, what are smaller value inflection points that you can create with your company. And I think later on, once you're more into the deal-making phase, sometimes founders keep them to themselves, whereas they do not yet have the experience, right? So, and in terms of valuation, that usually goes, okay, I'd say. However, when you come to all the legal clauses that are involved, that's where the stuff can get ugly. And I think that might be a very big mistake that founders are running towards if they do not recognize that.
Yeah, so maybe an example, valuation, you can be valuation sensitive. We want the biggest number for our press release or to tell at birthday parties. But if you then have a liquidation preference where the investor gets 2 times their money back or 3 times their money back, and you have that in your first round, you know the next investor will want it as well. So the more money you raise, the higher the threshold becomes before you actually make any money yourself. So you might own a bigger stake, but there will be less left to divide in the end.
And that's actually dealing with the legacy decisions that you make, right? So it might be in a very early stage that you think, this is fine. We'll manage this later on. But I mean, you have to deal with it time and time again, and realize that when you're setting up your first round. Yeah.
And maybe because often in the Netherlands, at least, the first funding is not an equity round as well, right? So a lot of convertible loans are in there. And that can be from venture capital, from other parties. That can also be a risk, I think, if you stack too many of those and you have a very high debt to convert. how are you going to raise your next round? So there's, I think, multiple problems. If all of the parties or the local parties, the usual suspects are already in a convertible, who will lead your round? Because they cannot really set a price sometimes. So they can just lean back and wait till somebody else sets the price. That can be difficult. And you will get a lot of people in your cap table at the beginning, especially if they don't take a big chunk of the rest of the investment. Then it can be more difficult for you. So convertible loans are a good instrument because it, especially in the early phase, it helps you delay the valuation point a bit, and maybe also make it an easier process in the beginning. But don't overdo it. I think it can also be too much convertible loans in your company.
If we continue on that, Joost, what would you say? What are effective ways for founders to approach investors? Because, well, looking at what you just said, should they focus, in your opinion, on finding the right partners rather than passively waiting for investors to show interest? Should they be on the hunt?
I think they should be at a hunt, but at the right moment. I think that's maybe also a mistake. Sometimes it's not the best to very early on speak to the investors you want to have on board, because it's a bit of a cliche, but you can only make one first impression. And if you made the first impression and maybe your first years you're a bit slower than you expected, then you already send them your plan for the next 3 or 4 years. And in the next first meeting, when you might be ready, they say, okay, but you're a lot slower than you told us 1 or 2 years ago. So I think talk with people who are not necessarily going to be your investor if it's a feasible plan, if it's a feasible valuation, then go out there. I normally say make a bit of a long list. Maybe not even start with your favorite investor, because you will learn and get feedback on your plans along the way. Don't be too afraid to perfect everything, right? So you need to start having first conversations long before you actually need the money. Maybe a year, 3/4 of a year or something like that already. Start your first conversations. Perfect your plan a bit, perfect your story a bit. And then approach the ones you want.
And in the end, this is all very objective, what you're talking about, right? So and in the end, what sometimes founders also forget or seem to forget is that it's just a people's business. And in that very first impression that you are setting with these investors, it is also the case that if you come in there and ask for, let's say, a 4 million euro investment while you've just been created as a company and you have no idea yet on what your fundraising strategy will be yet, or maybe your certification or go-to-market plan in general, it also reflects poorly on you as a person and as an entrepreneur. And that is a signal that you will also then need to counter in future interactions that you'll have with them. So also only opposed to only having the right plan, let's say, it's also about coming over as a strong entrepreneur who understands basically the game.
Yeah, and that's also a tricky part, because you want to have, maybe we'll come to it, but I think a lot of investors have more of a requirement for a percentage than they are valuation sensitive. So if you know you're going to give up 25-30% of your company in a round, of course it's most attractive to get that for the highest euro number. But if you get too high, it might not work. And if you first go speak to everybody, say, okay, I'm raising 6 million or something like that, and then you have to adapt because it's not working, and in the end you're asking for 2. It happens, and maybe it's sometimes a natural way. So it's also, how can you create a flexible situation for yourself where you can maybe leverage equity investments and still get to your total number amount without it appearing that you've changed your plans too much. So if you can create some flexibility in your finance plan, basically, it also can be a great asset, I think.
Yeah, agreed.
We've been talking about euros, percentages, shares these last couple minutes. But how can founders also ensure that investors add value beyond capital to their startup. What are your views on that?
Well, yes, I'll give this first to you. I think you have a very nice background on this.
No, I think it's really important that, especially for the first investors, that they are knowledgeable in the field, because they're also a bit of a brand on your company, right? So they've been able to attract that investor, and if it doesn't matches the field you're in, are not seen as the smart investor in that field. It's better if it's the perfect one, basically. So they can and will add value. However, you have to perform yourself as a company to get the time as well. So if you're doing great, you will also get, I think, in general, more support, or the best support. They want to help their winners. So just going for the name is also not the right thing. You need to be able. You need to know that you will get the attention from that fund, I think.
Yeah, and I think that signaling power is one of the most value-adding things that also an investor can do. Of course, let's say signaling trust and another independent person looking at this from a financial perspective also, and basically saying, there's money and returns to be made here. If you're then talking about, let's say, maybe operational or strategic value add, operational I would be wary of as an entrepreneur. Personally, because if an investor is very operationally active, there might also be some conflict in more than only the shareholders table, but also in the boardroom and also in smaller decisions there, that they're actively steering the company, basically. In other words, it can also happen in a very positive sense, right? So I've also seen very positive experiences happen with operationally active investors. However, I think most of the value is in that strategic layer. So these are investors that have seen multiple companies, usually in your specific sub-industry. And you can learn from the mistakes that other portfolio companies have made, right? So I think deriving that value from investors also starts with understanding what value they can bring. And if you as a startup founder, basically believe that they'll add a lot of operational value and help them maybe in your sales pitch or whatever, well, that might not be the case. But pointing you in the right direction and basically preventing you from making the mistakes that others already have made is, I think, the most value-adding thing that an investor can bring to you.
Yeah, and their network. A lot of them have a good network. They can open doors for you, for your first customers. They know other people who know other companies, and you get you in at a higher level inside another company than you might be able to do yourself. And I think, but don't just look for the big name. I think it might just be as important that you like the people, because you're going to be seeing them a lot for the next 6 years, and especially if it's maybe also some difficult times, it really helps if you can trust each other and you both like each other as well. It is a sort of dating process. So don't just go for the name, I think.
No, definitely. Don't only go for the looks, but go actually for someone who can understand you. Not only you for the business that you are, but also you for the person and entrepreneur that you are.
Nice. So if we go a little bit back in that process, say you're a startup and you're looking at either opening or perhaps delaying a funding round, how can founders, how can startups strengthen their negotiation position in this process?
Well, I think we already talked a little bit about signaling, right? So about the signaling effect, and that can come from investors, but it can also come from different types of activities. So if you're very early on, if you've just created your company, for example, pitching events might be a good way to start, at least to signal that other people believe in your product and your idea, and maybe your team. Of course, that's a very soft signal, but in the end, that's about signals.
Yeah, you look at me. I think it's also about creating options, right? So to get the best deal, they need to know that you have options, and they're not the only one. And that can also mean in the timing, you have to steer that a little bit. So if one investor is moving very fast, and they bring out a term sheet, and you cannot really talk to other investors anymore. They might be too fast for you. So ideally, you have 2 or 3 people a bit in the same stage of looking at you as an investment opportunity. So that means sometimes you need to hurry some of them a little bit, and also slow down the tempo of the fastest one a bit. Although I think everyone likes a fast process, so that's sometimes difficult.
Yeah, it's always a battle, but usually I use the metaphor of a job application, right? I think that speaks to the most minds of both PhDers that we're working for, or maybe postdocs who are trying to get into some form of a career. I mean, you don't want to have a job offer, basically with signing bonus, etc., and then say like, but I just met another company for the first time and I'm going through their process. So if you can wait 3 or 4 weeks, I mean, that really speaks to the minds of people that's a big no-no, let's say, in an investment process. So that job offer is the equivalent of the term sheet that's happening. And once you decide to go there together, well, there's no real turning back. Of course, there are legal options, but in practice, there's no turning back. So you'd like to have multiple job offers on the table.
Joost, you previously you already spoke a little bit about, well, in some cases it could be that at first you try to raise, say, 6 million, and then that doesn't work out and you bring it down to 2 million, or a startup has a certain timeline and thinks they'll be at some point in 2 years, and then it happens to be 3 years or 4 years. What would your advice be for founders to maintain control over their direction? Because it also sometimes happens, of course, that investors have different ideas or expectations.
Ooh. That implies that you can keep control. I'm not sure if that's always the case. So it's a bit dictated by investors. I think investors would like, for example, to ideally fund around a 2-year period, a 24-month period. But you as an entrepreneur might think, okay, but in 1 year, I will make such a huge step that I'll have a value increase. So I'd rather raise a bit less against this valuation and then go for the next one. But that doesn't really work for investors most of the time. So I don't know if you, in that sense, can control your own destiny. But when I just spoke about they would like to have a percentage, if that's true, then you don't necessarily want to raise less, because you will just get less money for the same percentage. Mm-hmm. So then it's good to raise for those 2 years. Then, of course, a lot can happen in those 2 years. So ideally, you have the room to extend that period a bit. Some investors are also able to help you there, to bridge towards the next round. They will put pressure on you if you're not making your timeline, because they're also worried that means you won't be able to fund your next round if you need one, and then you have to fire your employees, or they have to step in. So they will put pressure in the later stages, I think. But I don't know if that's a bad thing necessarily.
And I think also in your question, it implies a certain sense of that you know better as an entrepreneur, and in some cases that might be. But to extend that parallel of a relationship, let's say, with investors, as soon as you get into the moment of you're saying I'm right and the other one saying I'm right, and you're deciding between two paths instead of trying to bring them together, well, there's already a kind of like a crack in the relationship, right? So I wouldn't approach these things where investors are maybe saying, well, maybe you should look into this business model, or maybe you should look into that niche, as of them saying, well, you should do this and I can do what I want. Maybe you should accept it or listen to it and make it your own and try to come up with a mutual truth out of that. And I think that change of perception would bring you more than identifying that as, or approaching that conversation in a, let's say, risk-averse way of saying, I want to stay in control and I want to be the alone decider. From the moment you get people on your cap table, you're a co-owner of the business together, and you have to make it work together. So approach it as such.
Listen to each other, communicate, keep an open mind.
Yeah, and also realize that the roles are different, and maybe also the personalities are different. So most founders are by nature, a lot of founders are by nature optimistic, and that's why they were able to take the leap maybe to join the company, because they were optimistic that it would all work out in the end. And then it helps. Sometimes you might be too optimistic, so it helps that if somebody talks to you, okay, but you should worry about this. Maybe you should start worrying about this. And if you realize that you were probably optimistic because you took the step, you maybe when there was nothing, you said, I can create this. You're an optimist, maybe. So it's good that somebody tells you maybe you can be a bit too optimistic. So if you realize that, I think that also takes away some of the tension, and you can find find a conversation about it and find the truth and maybe a middle way.
Mm-hmm.
All right. If you could give advice to early stage startups that are just beginning to shape their investor strategy, what would you say is the most important advice? What would be the thing that you would want to tell them?
Do you have a minute? Yeah, I think both Joost and I can talk for hours and hours about these things.
Well, maybe limit it to 3.
Limited to 3. If I can name one, and then you can name one, Joost. So for me, it will really be start prepared, and that boils down to start on time, and also know what kind of business you are before reaching out and storming out of the gates and going to all different kinds of investors. Have at least some sort of a plan and be prepared. And I'm not saying with be prepared that you should have a 3-statement analysis of the coming 10 years with a liquidity forecast and everything. That's not what I mean. I mean, with what are your options? What are you trying to build, and how can you divide it up into different kind of pieces? As soon as you have control over that, you give yourself the flexibility to be able to, basically be nimble and choose different avenues of financing as soon as they open up to you. So that will be my number one.
Yeah, I was struggling maybe a bit more with the absolute best advice, but I think I kind of agree. So you have to figure out for yourself what's a realistic place to be in 2 years with the right funding, and you need to accelerate. So you need to be prepared to hit the gas pedal as soon as your money comes in, because there will be a limited time to show improvement. So be realistic on what you can achieve in around 2 years with the funding available, and in your pitching and speaking to investors, also be clear on that endpoint, basically that you're going to reach. It has to be realistic. Investors know if it's unrealistic, I think. So yeah, in the planning stage, that's, I think, one of the most important things.
You want a third one?
If you have one.
Well, we have lots of things, I guess. Let me think on it. We can cut this a little bit, right?
Of course.
Yeah. It's also it's difficult to have a general advice, I think, because every company is different in a way, and also if you're in different industries, it also works a bit different. If you're in medtech or something, it's
horrible.
Yeah, but it's also different things to do.
Yeah, right. But I think in general, it's realizing in what kind of business you are, and I think indeed, for one, it might be that investors are looking out for different things. So, for example, for medtech, it's really about a clear certification strategy, maybe. But in the end, those things boil down to maybe risk mitigation factors. So, what kind of perceived risks do we see? And how far are these risks also controlled? So, for example, for a medtech company, if you haven't been talking to the FDA yet, still you have a certain plan on certain certification. well, there's a lot of risk in that, right? So already that risk decreases immensely if you've only spoken to them once, because if you then laid out your plan and you think, well, this is complete BS, then at least you would have heard that at that point in time. So at least that complete showstopper won't be happening. So again, decreased risks and therefore increased potential, or at least today's value.
Yeah, and it's also, I think one of the things is investors like to see that you're not the only one thinking it's a great idea. So if you, in the early phases, talk to potential customers or suppliers or others in the space, they might not be ready yet to sign a contract or anything. But at least make sure that if potential investors would call them in a later phase of negotiation, they will have a positive story. So verify that they are able to be called by those investors, because they will call if you put them in your pitch deck. They will find somebody to talk to over there.
Yeah, definitely, and I think maybe to then do give an answer on your specific question on do you have really a tip, I think is creating a structure for yourself in that fundraising process. Things are chaotic. You might even forget that next to fundraising, you're also running a business. And you want to find time for actually, the fundraising activities. While it might be way more fun for you as an entrepreneur to be busy with your business, fundraising also takes a lot of time. And it really helps if you keep a tight administration, I've noticed, or at least entrepreneurs who have a list on who they spoke to, and when, what kind of was their interaction. Maybe it's also in the small things, right? Maybe they laughed about a joke or something about a dog or a cat or something. It's these small things that can also build that relationship with investors. And I mean, it only helps you if you write these things down, right? So it's a very maybe methodological approach to dating almost. In a sense that you're writing down things that people liked or disliked or something, but it really helps you down the line. As soon as you have that other interaction, then maybe again, people will feel heard and seen from that investor perspective. And that really helps and saves you a lot of headaches in forgetting names or interactions. Keep a tight administration. It will really help you.
Pay attention, cultivate that relationship.
And they are normal people, right? So you don't have to be too scared of too intimidated by investors.
Normal people with money. To wrap this up a little bit, in the next 2 days, Slush is taking place. Dozens of Dutch startups will be at the convention floor. What would you say to them? What to do? What to expect for the next 2 days?
I think Slush, an event like Slush, is a great opportunity to show your face, right? So a normal introduction might be sending a one-pager or a pitch deck or a cold email or getting a reference and having a 15-minute Zoom call. But here you can actually meet people, so you can also be a bit more relaxed, even because you practiced your story. Probably you've told it already 30 times that day. You can be relaxed in your preparation. You cannot over prepare either, because there's so many people walking around. You have to react to the people you're speaking to. But that means that they can also get the first impression. And I think in the beginning, I also said you need to like each other on a personal level as well. So try to find that connection. And then don't expect a deal here, I think. So be sure to follow up while they still remind who you were. Maybe also try to be a bit more rememberable. I don't know if that's a word, but if you have a conversation, try to make it fun for everybody so that they remember you, because those people will also have a lot of meetings.
In the end, you want those investors to feel like, this was a fun interaction. This is a nice guy or girl to work with, because in the end, you will be working a lot with each other if it does come to be an investment. I think, well, of course, people have had to prepare, and we've also helped them during our workshops. I think this one was in Dutch in Utrecht for this edition, but for most different conferences, we're hosting such a workshop to help entrepreneurs and prepare for those conferences in the right way. For, let's say, last minute advice, just be nice. Be a nice person, smile a little. I mean, it can be very tiring, but in the end, it is a people's business. In the end, you are building relationships, and you're not your nicest self when you're very tired. Well, probably you will be very tired after 2 or even 3 days of hard networking. But try to fight through that and try to find your most positive version of yourself. And as if they would say in restaurants, horeca lach aan. Just smile a little, be a very positive person in there, and just try to sell your business, but also yourself as a person in that way.
I don't know if that's to be a horeca smile, because you should also just enjoy yourself. That's the best way to have a.
That's indeed the best way. But I
genuine interaction with a genuine smile.
I think in English they say a smile can go a long way. Albert-Jan, Joost, thanks both for your time and presence here and insights at the podcast.
I'm glad to be here.
Yeah, thanks a lot for having us.